Hello and welcome to another episode of our RHB MERGE Podcast, where we bring you experts' perspective on the latest economic trends and developments shaping the financial world. I'm Nova Lui, Head of Investors Advisory from RHB Bank. Together, we have a very special guest joining us. It's my pleasure to welcome Mr. Barnabas Gan, Group Chief Economist of RHB Banking Group. Mr. Barnabas is a leading voice in the economic landscape, known for his deep insights into global market and his ability to simplify complex economic trends for all of us. Together, we will be diving into a highly relevant topic, the impact of US tariff on global trade and investments. With news on US tariff evolving rapidly, this is a conversation you don't want to miss. So let's get started. Given the 90-day pause on tariff and the recent rebound in US equity market, do you think this is an opportunity for investors to rebalance their portfolio to hedge against potential tariff resumption or further escalations?
Yeah, so good day, everybody. We are speaking at unfortunate and uncertain times, and I think the uncertainty in the current environment essentially means further downside bias for equities. We do see some comfort from the postponement of the tariffs for 90 days, but however, from the base case scenario, we still think that some further escalation of tariffs towards the 20% universal tariffs into the third quarter might still come into play. And that basically means that the equities markets might still continue to stay on the downside. For those who have been in equities market, who have exposure, probably market weight on them, keep it on hold in hopes for a recovery probably into the fourth quarter. And for those who have maybe a little bit more of exposure in the fixed income, still stay overweight on quality fixed income. And probably on safe haven as well, like gold and US treasuries.
With the US imposing a 125% tariff on Chinese import and China retaliating with a 84% tariff, what are the long-term implications for China's economy, especially in terms of growth, trade, and investments?
So I think for the 125% tariffs on China, there are two ways you can look at it. I think one, what we can see is that the US demand for Chinese imports will likely take a very strong step down and probably totally negates Chinese export to the US. But however, I think a second way to look at it is perhaps the fact that China might redirect its exports to the other trading partners such as ASEAN. And that basically gives us probably another strong bias for ASEAN because of the fact that now we have a very strong trading relationship with China. And some of the spillover effects could mean a increase in raw materials and semi-finished goods into ASEAN. And that means that maybe production costs in ASEAN could actually take a leg down. But I think perhaps the risk is what US may do in terms of tariff issues. And that may come into the form of, say, tariffs against ASEAN countries if they trade with China. And that could be one of the scenarios that we can consider. If that's the case, then I think perhaps we will continue to stay bearish on China and for the Chinese GDP to actually go to as low as 4%, if not lower, into 2025.
China's equity market is slightly elevated with the expectation of the big stimulus from the Chinese government. What's your thought on this?
So, of course, Chinese stimulus as well as monetary and fiscal stimulus will be the forefront of investor consolidation into 2025. And that is also what that is underpinning our GDP forecast of about 4% for China. The full blow of tariffs on China without monetary and fiscal support means that Chinese GDP could fall to as low as 2%. And that is actually likely not a case that the Chinese government may want to see. So with monetary policy probably at play, we are penciling in, perhaps maybe 150 basis point cut in its RRR and a 75 basis point cut in its LPR. And that should be enough to lift Chinese GDP to at least 4%. We do not discount further monetary and fiscal measures to be introduced to support Chinese growth into 2025. But at least at this juncture, we think that the Chinese GDP growth at 4% will likely be one of the print that we will be looking at for the rest of the year.
How do you anticipate equity market in ASEAN country will perform under this tax tariff? Specifically, when it comes to Malaysia, how would we react, and how is the implication of the tariff in Malaysia generally? And is there any sector within Malaysia that could potentially benefit or be more impacted?
So the key export industries in Malaysia remains to be three industries. One is the E&E, second is the crude materials, and last but not least is machinery and transport equipment, or more so capital goods. And this perhaps will be the overarching industries that may see further downside bias if tariffs are escalated into the future. Now that we are seeing a 10% tariff, then perhaps these are the industries that we should be cautious about. And really, if we are looking for further downside for demand for these industries, then we are actually penciling in a base case for Malaysia GDP at 4.5% for this year. What this basically means is that there is downside risk from our 4.5% forecast. And the downside risk will be underpinned by further escalation if the reciprocal tariffs are reintroduced with a greater vengeance. And that basically may pull Malaysia GDP downside risk to, even below a 4% handle. And that could actually mean that the other regions in ASEAN as well, the other economies in the ASEAN region as well, to further take another step down in GDP growth.
Barnabas, you mentioned about your overweight view in fixed income, and market actually pricing in up to 5 times a rate cut in 2025 with the speculation of about a significant cut by June. What do you think about the market expectation? And do you think there is a market has priced in too much of a cut?
Yeah, so the 5 rate cut expectations that has been priced in by the market to us is a recessionary pre. It is of no surprise that markets at this juncture are pricing in a recession given the tariff measures that was once introduced before the postponement of 90 days that was being announced. With the postponement, the market swap pricing has actually gone down to 3 times cut as of the 9th of April. So that essentially means really for the fact that the rate cuts, in our view, is still at 3 times, and this is really in line with what the markets are saying. We don't think that a recession is going to take place. Hence, a 5 rate cut scenario might not be something that we are subscribing to at this juncture.
Thank you very much. This is my last question. We want to have some insight about currency. What is your projection of the US dollar against other currency like ringgit, maybe also Aussie dollar? How might the trade flow and central bank policy influence the currency valuations?
So I think what right now at this juncture, given that the swap pricing has been discounted to 3 rate cuts, investors are now a little bit more optimistic on the US dollar, and that basically explains the marginal rally in the dollar as of 9 and 10 of April. And that in mind, if the US really continues to cut by 3 times this year, then perhaps dollar with its fully priced in rate cuts really at this juncture of 3 times, if not 4 times, will mean that DXY will be at around 103, 104 towards the end of this year. If there is going to be further escalation of tariffs, then we do not discount that the dollar will weaken even further below where we are, say, right now. With the weakening dollar, then perhaps we will still be looking at, say, the dollar ringgit to move closer to 4.3, if not 4.2 per dollar by the end of this year. And that will be likely music to everybody's ears, given the stronger ringgit that we may see into 2025. So I think Aussie dollar is a very special case right now because the slowdown in growth will mean that risk asset prices such as base metals might take a step down. And of course, China, which is the largest, if not one of the largest consumer of base metals in the world, might also take a step down in its demand, given that there may be some slowdown in growth, and demand prognosis. That basically means that there's downside risk. for risk assets such as risk commodities such as copper and base metals. And with Aussie and say the New Zealand dollar, perhaps it's very much related to base metal prices. That could mean that the Aussie and Kiwi might remain slightly on the weaker side, given that the risk appetite or commodity appetite into 2025 might be lackluster for the year.
That brings us to the end of today's insightful discussion. A big thank you to Mr. Barnabas Gan for sharing his expertise and shedding light on how US tariffs are influencing the global economy and investment strategies. Your analysis has truly been invaluable. To our listener, as we have discussed today, the dynamic around US tariffs are constantly changing, and staying informed is crucial for making sound investment decisions. We encourage you to stay connected with your RHB relationship manager for the latest update and tailored advice to navigate these uncertain times. Once again, thank you for tuning into RHB Merge Podcast. Until next time, stay informed and take care.